Hi, and welcome to another edition of Coffee with Brendan. Today's episode is one that, if you haven't heard about it yet, it's definitely something you're going to hear about as we get closer and closer to the 2024 presidential election. And that is ESG investing, or what some conservative talk shows and conservative candidates like to reference it as woke investing. And so what is ESG investing? I will talk about that today, some of the pros, some of the cons, and then ultimately look at one metric that actually shows the performance of ESG type investing strategies versus non-ESG or more traditional type investing strategies. So why are we even talking about it? Well, first and foremost, 90% of all companies that make up the S&P 500 publish something as it pertains to ESG. They publish some kind of ESG report. And in terms of growing, these types of investments have grown from about $5 billion in 2018 to 20 times that in 2022. So over a 5-year period, the growth rate has been about 20 times. There in 2022, over $100 billion went into ESG type funds. And it was in 2022 that there was a turning point with ESG investing. And that's when Ron DeSantis tried to put together a coalition of 18 other states that tried to ban ESG scores from being considered when making investment decisions, specifically with state-run pensions and things like that. And so that's pretty much a background of where we've come and why this is important. But let me spend a couple minutes talking about what actually is ESG investing, because I think we have to start there. So let's jump into that. Let me just open up my screen here and get into that piece. So ESG investing combines three principles: environmental, social, governance. And environmental is exactly as you expect: pollution, carbon footprint, carbon emissions, things like that. So you get a score for your environmental impact as a company. Social is, customer satisfaction, data protection and privacy. Gender and diversity, which is one of the reasons why folks get really upset about this, is that they feel like gender and diversity doesn't add anything to whether or not an investment or a company should be invested in. Community relations, employee engagement, human rights, and labor standards. And then you have your governance, and board composition is probably one of the hot topics as to why, again, opponents of ESG investing really take an issue with. Why does it matter, if there are too many men or too many white people or too many whatever on the board of directors of a specific company? Another piece is executive compensation. Does the CEO make this much and the lowest person make this much, or is it closer? That's something that ESG folks pay attention to. So when a third party comes in and measures a company's ESG score, what they're basing that off of are these three main principles. Now, turning the page for a moment, there are different ways of scoring. So the first way, and probably the least, or let me put it differently, the most consistent with traditional investing, is what's called negative screening. Still, what a negative screen ESG strategy or fund is looking at is they still want performance first and foremost. They don't really, I shouldn't say they don't care. They want performance first and foremost. And what they're doing is screening out certain companies that are in the weapons, tobacco, alcohol, gambling, adult entertainment, and oftentimes carbon, or the oil companies and things like that. That is probably the closest to traditional. So if we're going on a scale, the first one is traditional investing, doesn't take any of these things into consideration. The next step up the ladder is negative screening. That is pretty much traditional investing adding negative screens, getting rid of some of those companies that are the quote bad companies. Then we get into the ESG integration. And that's probably what we're talking about here, is actually not just taking out those companies that don't have high ESG scores, but actually rewarding those that do. And so that's where you're still looking for performance first and foremost. But and we'll talk about this when we get to the pros and cons, what supporters of ESG investing would say is those companies that have high ESG scores tend to have good stock performance and good profitability as well. Then we get into shareholder advocacy. So that's taking it one step further and using your proxy votes to dictate the future direction of a company. So not just investing in the company, but also proactively using your proxy votes to actually direct the company one way or the other. And then this last one here, the impact and community investing, that is probably where a lot of the people feel like the opponents of ESG investing probably put a lot of their eggs. And this is pretty much saying that the ESG impact is more important than the performance, that people are willing to sacrifice rates of return for diversity, inclusion, all those types of things that are hot buttons for in the political arena that we're in right now. And so what we're talking about today is that more the ESG integration as opposed to this impact and community investing. That does take it one step further, but what we're still talking about is ESG integration, and does the inclusion of adding ESG scores into an investing decision actually impact the future performance of the investment? And so let's get into the pros and cons right now of ESG investing. So the pros, if we look at this, is that for those companies that tend to score higher on ESG, they typically have above average risk control and compliance standards. And so that helps them. And again, this is what the argument would be for adding ESG scores into investing decisions. That would reduce a company's exposure to things like accidents, fraud, lawsuits, boycotts. We saw that with some of the companies, that some of the more liberal people stayed away from things like Goya, for instance, because the Goya president was seen with Trump or supported Trump or something, where people boycotted him because of that. And that led to profits going down because of it and other adverse events. So having a high ESG score, the supporters of adding ESG would say that it reduces your risk to things like that. But the other piece, and this is one that I think has merit. Like it or not, younger workers who are coming out of universities, they care about this stuff. They want to work for companies that they feel are values based and purposeful in how they spend their money and treat the world, treat the planet, and make up their boards of directors and things like that. And so by not having a high ESG score, you run the risk that you're not going to be able to attract the highest level of talent. And so I think that of all of the different positive points of including ESG is the most important with this. So let's flip the page and look at some of the cons. And the cons really amount to I'd say two things. The primary thing is what Ron DeSantis would say: gender inclusion, diversity, all that kind of stuff doesn't matter. It's a distraction, and it's having people focus on the wrong things and allocate resources, time, and energy to something that's not going to drive company performance. So that's the first one, and probably the primary one. But the second one, which again, I'll throw my editorial comment in here, I think does have some merit, which is that ESG scores are not consistent. There was a study by MIT that showed that of 6 major ESG ratings firms, they found that the correlation of their scores is only 61%. Compare that to the 3 credit agencies that weigh in on your credit worthiness, and they have a 99% correlation. So we're looking at a 61% correlation among 6 ESG ratings firms compared to 99% for the credit firms in the United States. So that is an issue. And what supporters would say is that they acknowledge that, and they say, listen, we stipulate that that's an issue. However, the scores are getting better, and these firms are coming together with different and coming to an agreement on what's important and what's not important. So ultimately, the big question that's on everyone's mind is, does it make a difference? And can we point to anything that actually says that, adding ESG scores in or not adding ESG scores in does or does not impact performance? And so let's take a look at a couple of the bigger or the most popular ESG funds that are out there. And so I'm looking at iShares. iShares are exchange-traded funds. And what the iShares here are the S&P 500. So the iShares Core S&P 500 compared to the iShares MSCI KLD 400, which is it follows one of the most commonly tracked social index, socially responsible indices. And you can see, and maybe you can't see, but long story short, the average annual rates of return are actually very close. If we were to compare these and actually put them on top of one another, then what you're looking at is, give me one second, I got to share the screen. What you're looking at is something that looks like this, where the blue line, and again, I know this is very small, but the blue line is showing where the S&P 500 outperforms the KLD 400. And you can see that at different times, they're very close. If you look at that, this here, this IBV versus DSI, you can see that over time they're very close. Where there have been times where the S&P 500, which is the IBV, has underperformed the KLD 400, but then recently, especially in 2022, it's actually caught up some. And the furthest that we have here, the furthest one that I can pull is January 10th, 23. And cumulatively between those two, you're looking at 249% positive for the S&P 500, and the KLD 400 is about 251%. So almost exactly the same since 2007. So again, take it for what it's worth. I will say, and again, I have to be fair here. The KLD 400 is more of the negative screen, where they're taking, all the different companies that are represented and screening out those alcohol, tobacco, firearms, and coming up with that. It's not as much the ESG, where they're actually rewarding companies and overweighting towards the companies that are actually doing well from an ESG standpoint. Phew. So I think let me put it differently. I hope I gave a balanced view on this. More than happy to talk about it more with you on a one-on-one basis, but at least this is a primer on the ESG and why it's important and why it's going to become a hot topic for the 2024 election. So be well, do good, and we'll see you next time. Bye-bye.